In this video, we'll go through how crypto taxes work in the United States for the 2025 tax year filed in 2026. We'll cover what can be taxable, what is usually not taxable, which records you need, which forms may apply, and how to prepare your crypto tax report. This video is for educational purposes only. Crypto tax can depend on your personal situation, your state, your income, your activity, and how your transactions were made. If you are unsure, speak with a qualified tax professional. The goal of this guide is to give you a practical overview. By the end, you should understand the basic workflow. Collect your crypto data, classify your transactions, calculate gains, losses, and income, and prepare the information needed for your tax return. The U.S. tax year usually follows the calendar year from January 1st to December 31st. So, for a 2026 filing, you are usually reporting crypto activity from the 2025 tax year. The standard federal filing and payment deadline for 2025 tax returns was April 15, 2026. Federal tax returns include a digital asset question. The IRS asks whether, during the tax year, you received digital assets as a reward, award, or payment, or whether you sold, exchanged, or otherwise disposed of a digital asset. This question matters, so do not ignore it. For U.S. federal tax purposes, digital assets such as cryptocurrencies, stablecoins, and NFTs are generally treated as property. This means crypto transactions can create capital gains, capital losses, or ordinary income depending on what happened. Common taxable events include selling crypto for US dollars, swapping one crypto for another, spending crypto on goods or services, receiving staking or mining rewards, receiving airdrops, and earning certain DeFi rewards. The tax treatment depends on the type of transaction. Some activity is usually not taxable by itself. Buying crypto with dollars is usually not a taxable event. Holding crypto is not a taxable event. Moving crypto between wallets you own is usually not taxable either, but you still need records so that these transfers are not mistaken for sales. When you sell crypto for dollars, you are disposing of a digital asset. To calculate the gain or loss, you compare the amount you received with your cost basis. If you received more than your basis, you may have a capital gain. If you received less, you may have a capital loss. A common mistake is thinking that tax only applies when you cash out to dollars. In the US, exchanging one crypto asset for another can also be a taxable event. If you trade Bitcoin for Ethereum, you may need to calculate the gain or loss on the Bitcoin you disposed of, using the US dollar value at the time of the trade. If you spend crypto to buy goods or services, that can be treated like a disposal. From a tax perspective, it is similar to selling the crypto at its fair market value and then using the proceeds to make the purchase. This means a gain or loss may need to be calculated. Not all crypto tax is capital gains tax. If you receive new tokens from staking, mining, airdrops, rewards, or payment for work, this may be treated as income. The value is usually measured in US dollars at the time you receive the crypto. Some transactions can create two separate tax moments. For example, if you receive staking rewards, the value may be income when you receive the tokens. Later, if you sell or exchange those tokens, you may also have a capital gain or loss based on the change in value after you receive them. The holding period matters. If you held the crypto for 1 year or less before disposing of it, the gain is usually short-term. If you held it for more than 1 year, the gain is usually long-term. Long-term capital gains may receive lower tax rates depending on your income. The basic formula is simple. Proceeds minus cost basis equals capital gain or loss. But in crypto, the hard part is usually getting the data right. You need dates, amounts, fair market value in US dollars, fees, and the correct basis for the units you disposed of. Cost basis is generally what you paid for the asset, usually measured in US dollars. If you received crypto as income, your basis may start from the fair market value when you received it. Fees and transaction details can also affect your calculation. Cost basis method matters because it can change the final gain or loss. Many taxpayers use FIFO, meaning first in, first out. Specific identification may also be possible, but your records must clearly support which units were sold or disposed of. Do not guess randomly. Moving crypto between your own wallets is usually not taxable by itself, but it is still important to track it correctly. If a transfer is not matched, software may think it was a sale or missing acquisition. Network fees can also matter, especially if they are paid using crypto. Different forms may apply depending on your activity. Capital gains and losses are commonly reported using Form 8949 and Schedule D. Crypto income may be reported on Schedule 1. If the activity is business or self-employment related, Schedule C may apply. Some users may also receive Form 1099-DA from brokers. Form 8949 is used to report sales and exchanges of capital assets, including digital assets. It contains transaction-level details. The totals are then carried to Schedule D, where capital gains and losses are summarized. Form 1099-DA is used by brokers to report certain digital asset proceeds. But receiving a form does not automatically mean your tax calculation is finished. Some forms may not include complete basis information, especially for earlier reporting periods. You still need to calculate and verify your gain or loss. DeFi, NFTs, stablecoins, liquidity pools, and bridges can be more complex. The tax treatment depends on what actually happened. Did you receive new tokens? Did you swap assets? Did you dispose of an NFT? Did you earn rewards? Each case may need to be reviewed carefully. Crypto losses can matter. If you sold or disposed of crypto at a loss, that loss may help offset capital gains. If your losses exceed your gains, there may be limits on how much can offset ordinary income in the current year, with unused losses potentially carried forward. Scams, hacks, rug pulls, and worthless tokens are complicated. Do not assume that every lost token automatically creates a deductible loss. The facts matter, documentation matters, and this is one area where professional tax advice can be especially important. Good records are the foundation of a correct crypto tax report. You need dates and times, assets, amounts, US dollar values, fees, wallet addresses, exchange history, and transfer records. If you use multiple exchanges and wallets, you need the full picture, not just one account. The most common mistakes are simple but serious. Ignoring crypto-to-crypto trades, missing wallet transfers, using incomplete exchange data, forgetting fees, not tracking staking or airdrop income, and assuming that a tax form from one broker includes everything. A practical workflow looks like this. First, export or connect all exchange data. Then add wallets. Next, match transfers so your own wallet movements are not treated as sales. After that, review taxable events, calculate gains, losses, and income, and generate the reports you need. CryptoTaxBridge helps you turn exchange and wallet data into a clearer tax report. You can import transactions, review your trades, check gains and losses, and prepare PDF and CSV reports that can help with filing or with sending information to your accountant. Before filing, make sure all exchanges and wallets are included. Check that transfers are matched, income is reviewed, fees are included, and your reports are exported. Missing data can make your final numbers wrong. If you want to prepare your crypto tax report, you can start with CryptoTaxBridge. Import your transactions, review your data, and generate your crypto tax reports. The link is in the description.